Hello, hello. So today is chapter 2. This is going to be speaking the market's language. One second. Perfect. So speaking the market's language. Before you trade the market, you know how it speaks. Markets communicate through the price, not words. Charts are a language, not a prediction tool. Every candle contains information. Understanding comes before execution. Fluency removes hesitation. This chapter teaches how to read prices. No signals, no shortcuts, only structure. So the idea is before you actually get into the market, you can use a little bit of technical analysis, see what the indicators have to offer. Slowly goes into algorithmic stuff with Claude and everything. But generally, to know what's going on in the markets to make good financial decisions is always very important. So, for example, you could draw like a little line from here through there. And you could see that this is the breach point. Once it breaks, then this huge move downwards can occur unless it gets pulled back up, which it probably just did with that green candle. And that's kind of interesting stuff to the entire market. And then this level could be this level right here. If you drew a candle correctly, then yeah, that would be a perfect level. So kind of doing a little bit of technical analysis, giving it 15-30 minutes before you truly start trading during the day, because it's a job that you can do in 2 hours in a day instead of working 9 to 5, and it makes it way easier to actually understand the entire concept of everything. Marking out your FEGs, IFEGs, all those kind of things is extremely important, and generally seeing what is the volume, what's the general intent of the day, are there any news that could harm CPI, Donald Trump said something, is there more war going on, anything can happen in those ways, depending also what you trade. If you're trading crude, could be something in those ways, could be a tech stock like NASDAQ, the ES as well could be super interesting. All those kind of things have different correlations to each other, maybe sometimes to currencies. Let's say the franc gets stronger, which it has been getting stronger, and the dollar is getting weaker. What's the correlation to the British pound somehow? Or if it gets stronger, does that affect the NASDAQ, for example, because the dollar is worth less in these moments, meaning the market would probably go up. Certain correlations, all those kind of things, always good to look at beforehand. What are certain percentages that, for example, the Magnificent Seven are going up? If NVIDIA, the biggest market cap in the entire NASDAQ and weighted average into the NASDAQ, is going down quite a lot, are the other stocks keeping the market up? And then when NVIDIA goes up the market, why this chapter matters. Most traders who misuse should inform, not dictate. Misreading prices creates false confidence. Understanding structure improves timing. This chapter removes guesswork, and language comes before strategy. You can always wait for a good strategy to come up. Things about trading that you want to actually figure out what is going on before everything is happening, because once you are in the market, it can get, depending on your risk reward, you don't always fully know as a retail trader what is going on. If you're putting one contract in, one mini contract, and the market is going up 10, 50 points per candle, you kind of already put yourself into a very interesting area, because the market too quickly and you don't truly know the risk that you're putting onto it. Over time and with knowledge, you can start using minis. But I would advise to go with micro contracts at the beginning so you don't blow up too many accounts. Price as information, price as data, not direction. Candles reflect decisions made by participants. Every movement shows acceptance or rejection. Price tells a story over time. Context matters more than single candles. Interpretation beats reaction. Information precedes opportunity. So let's say the market is right here. You're like, okay, it's sideways, sideways, sideways. Slow redo. You can either play short or long. Sometimes there's a quick fake out and it goes that direction. So that's one of those things where you kind of want to know, why is it going in this direction? Is it totally overbought with the relative strength index? Is there a huge volume wave that just came in? Is there a lot of delta that just entered? Or the market just opened somehow and that's why it's shooting up like this, because it's very bullish for the day. And because it moved that quickly, then slowly you can be like, okay, I will start placing shorts all the way up, hedging my bet until it starts coming back down. But sometimes that's a very bad strategy. You sometimes just want to run with the flow and then position yourself correctly. But in theory, if you wanted a larger move, you'd hedge, 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 and then let it go all the way back here. And that's actually what the good traders do, because they do stacking. That is what most institutional banks and firms do. They stack all the way up, and then they can sell all the way down, and they make a little bit of profit on all of these all the way down here. Because they have so many more sells, then this is the perfect area to get out of the market. That's truly what the market does. Candlesticks, what they really show. Open shows where participants began. High shows where price was rejected. Low shows where price was supported. Close shows final agreement. Body reflects conviction. Wicks reflect disagreement. And candles show behavior, not signals. Sometimes, you probably have seen this before, that the market just goes up 10 points and wicks all the way back down and all of a sudden shoots down 10, 20 points. Because it was, candle will be strong up here. A lot of sellers came in, pushed that candle back down, and that leads to the market then reversing and going the opposite direction. So that's why a lot of people always love that strategy, that they wait until the hourly candle closes, they wait until the 15-minute candle closes, 4-hour candle closes, 5-minute, and so on. Very important. Candles are not signals. Candles do not predict the future. No signal candle guarantees direction. Context defines meaning. Patterns define. Candles confirm participation. Interpretation requires environment. And signals without logic create noise. So that's all the things. Sometimes it just isn't the exact same as it was the last time that pattern occurred. So a lot of the times there's certain things one has to wait for to truly get a confirmation into a trade. So that's why it's always good to be patient and wait on the sidelines and sometimes do nothing. And that's the biggest thing about trading. The patience adds to the discipline. It's super easy just to be like, okay, I want to trade more because I made more money and I want to make more money to get to my payout quicker. And today I already had this amount of money. But if you had $2,500, let's say, per day, or made it in one day, then all of a sudden you put in one contract and the entire market just completely falls or drops and you're in a long and you lose $800 and you're back to 1,700, which would not be great. Or of course, if it goes well, you know, there's always, it's your risk and reward. You can do whatever you want with your money, but those are the kind of ideas. At some point, it's good to just close the laptop and let it be for a day, because it's the long game that really helps. Stacking days, 5 days in a row, 500, rather than making one 2,500 day and then losing the next day, and then again a little bit up the next day, and then losing again, and your end of the week is only $500. It's way better to be consistent, and that's why it's good to start figuring out a strategy that keeps you consistent. And not every trade will be a winner, but cutting your winners loss, with your losses early is very, very important, and then trying to get that wins back is always nice. But revenge trading is one of those things that I don't fully believe in. If there's a new structure, your emotions are playing the entire time anyways, so let the fight or flight kind of out, and sometimes listen to your intuition and get into those positions you truly believe can work out. Tick size, market granularity. The size is the smallest price movement. Tick size is set by the exchange. Price cannot move between ticks. Tick size defines precision. Smaller ticks allow finer control. Larger ticks increase volatility impact. Understanding ticks prevents sizing errors. So these ticks are also known as pips. So for example, 0.25 is the one on NASDAQ. So 1 point is 4 ticks, which is $20 on a futures contract in a mini, and $2 on a micro. And ticks are very important to kind of understand over time. And there's a lot to it in the financial markets with these kind of things. Silver, for example, 2-3 months ago when it was just skyrocketing, the market would go up a few dollars, but because of the way that silver moves, the ticks would be like macros or micros would literally fly up thousands of dollars in a matter of 2 seconds. A lot of my friends that were on prop firms, that's why they also got not banned, but they didn't get their money out, made in 3 days because they just over leveraged in over leveraged themselves 500,000 in 2 weeks or so just by trading with a few contracts. Crazy. Tick value defines money gain or loss. Every market has a fixed tick value. Profit and loss move in ticks. Risk must be calculated in ticks. Small mistakes scale quickly. Understanding tick value protects capital. Math removes emotional trading. So doing a certain thing like saying, okay, I'll go for 10 or I'll go for 10 pips would be like $50 a trade, and you would lose like a 1-to-1, 50 to 50. So each time you could do something like that. There's great traders that do that kind of thing. I personally go for higher win rates, which is like a very low tick amount and a very high risk amount on the opposite side. Sometimes comes back, but if you really trade in a certain way that you're going for these trades right here, where the market just drops down, like this is a perfect example. So I'm a range trader in certain ways. I love these as well, which I can trade with IFPGs and FPGs. So I'll go for the long trade. This is one that I have more confidence in, like an 8-trade setup. Then in here, because it's prop firms, I'm trying to make money quicker. I would go like figure out the mid-level of this. That's when I get out of the market for a little bit. And this doesn't always happen. And then you can also just set your loss once it reaches that level. And it's one of the best things to do to just get your prop firms on the road and start making real money. And you get a lot more time in multiple contracts. Then you amplify your mistakes. And the market moves very differently with the multiple contracts, depending if live environment to simulate environment. So very, very interesting. So be very smart about all these things. And generally the risk also, if you're seeing the market go up and you make $5,000 in 5 minutes and you're just new to trading, it's kind of a thing that gets you very keep playing that game. But the thing is, on the opposite side, you could have also lost $5,000 and blown up your account or your live account or prop firms or anything in those ways, which is not great. That's why you should kind of see what you can handle and see what like your good amount of money is. If you're looking at average income around the world and generally trading with multiple accounts, if you're very precise and do a great job over time, if you can get over a 6-figure income from just trading prop firms and making 10 accounts, all you really had to do or really have to do is get like 10 accounts. You go 200 days positive, 256 days. So you have 10 accounts times, you make $200. That's 2K per day times 200 days. That would be 400K. Okay. So let's say the lower margin of this. Let's say you have 5 accounts. Well, that'd be half. That'd be 200K. So all you really need to have is 2 accounts and do that kind of thing with $200 per thing, which is 10 points per day on the NASDAQ with 2 accounts or 2 contracts, and you'd be at the 80K margin, which is pretty great. Time frames, price compressions. Okay, all time frames show the same data. Lower time frames show details. Higher time frames show structure. No time frame is superior. Context comes from alignment. Time frames net inside each other. Perspective improves decision making. It is true there is no real perfect time frame. It just depends to you. If you're trading scaling wise, 15 minutes, 1 minute, 1 hour, 5 minutes, 4 hours, 30 minutes, I think. All very, very good, but sometimes you can see it like the 15-minute chart, if the Bollinger Bands get the hit or it moves past the 15 minutes, a reversion is kind of higher, or a reversion or coming back is way, way higher. So certain odds kind of increase with the idea of certain time frames. If you go from 4 hours to 1 hour to 15 to 5 to 1, you can kind of see, okay, the market's slowly going bullish, so then you can kind of go with that trade longer because the entire market now is turning around. Then we can go the opposite way, 1 minute, 5 minutes, 15, 1 hour, 4 hours, and you see the market slowly going bullish in all of them, so that's the best way to do it. Multi-time frame thinking. High time frame defines environment, lower time frame defines execution. Exactly, that's how I mean it. Trading against context increases risk, alignment improves probability, conflict creates chop, structure flows downward, timing flows upward. Always be patient with your trades and be very, very smart entering, because at the end of the day, if you can just go almost 100% win rate, which is unplausible, or you just decrease your, if you can go 100% or like close to that on a daily, not every single trade. Let's say you have 50% win rate for each trade, but your win to reward is good enough. You can almost go every day positive that you trade, because you don't have to trade 200 days a week or 200 days a year. So let's say again, as an example, you have 10 accounts times 200 times you trade half of the year. 100 would be 200K. So you should even trade 50 days that you actually have high belief in that there's that one trade that goes up 10 points. Pretty simple. And that's the cool thing about trading. And that's one of the crazy things. When price matters most, not all hours are equal. High liquidity creates opportunity. No liquidity creates noise. Participation defines reliability. Time improves clarity. Patience filters bad trades. Waiting is a skill. Very important. Range versus trade versus trend. Ranges show agreement. Downward trend shoots up. Downward trend. Misclassification causes losses. Ranges reward patience. Trends reward timing. Environment defines execution. You can honestly trade any way you want. So many different traders are successful, so just figure out a strategy if you want. Psychology is very important. That's one of the big things about the language of the market. Reading price is context. Candles mean nothing alone. Location defines importance. Time adds confirmation. Structure adds bias. Liquidity adds intent. Context creates clarity. Clarity reduces mistakes. Very important to have a clear mind when entering the markets and just kind of figure out what truly matters. Charts are language. Candles show behavior. Ticks define reality. Timeframes provide context. Sessions define participation. Interpretation beats indicators. Fluency improves confidence. So being confident about your trade even when it goes wrong, having a good stop loss and other things too is very important. I personally don't like stop losses that much because I kind of like to trade like a quant where I just add another contract at my stop loss if I see it come back from that level, because you can kind of just mark out all the areas that you would put as your stop loss. So I sit in front of my screen a little bit longer rather than not sitting in front of your screen and just letting it run like that Alex G guy who just says, close the laptop after you did the right thing. And he usually hits trades out of the ballpark like this one. So each person to their own, and just got to figure out what truly matters to you out of all of these great concepts over here. And those are the most important parts out of chapter